Succeeding real estate's most competitive asset classes, value-add multifamily residential properties. My guest today, Max Sharkansky, managing partner at Trion Properties, is a successful repeat user and strong real estate investing. Welcome to the National Real Estate Forum podcast, episode 219. Thank you for joining me today. I am Dr. Adam Gower, and this is the Crowdfund project at nreforum.org, where developers, investors, and industry leaders share insights that you can use to raise capital, build wealth, and earn passive income from crowd-funded real estate deals. In all the online and offline training to investors and sponsors that I give about how to raise capital or invest in crowdfund real estate deals, the first thing I like to talk about is the fact that real estate is a cyclical industry and that prices will come down at some point. The message is, of course, that if you can keep your head when all about you are losing theirs, to quote Kipling, then you can stay ahead of the crowd, to quote me. But it's the crowd, to quote me. But it's very difficult to predict a market downturn and takes a lot of courage to exit when the market seems to be charging relentlessly upwards. For a sponsor, it's easy to get caught up in the idea that this time it's different and to want to continue to build to keep their development machine in operation. For investors, there is always the fear of missing out. I was talking to Dror Poleg, who is a seasoned private equity guy, about how private equity finance works and the impact of crowdfund real estate on that industry for a future podcast when the subject of cycles came up. His advice to avoid the hard lessons of real estate is to invest with the macroeconomic trends, i.e. ride the wave up and get out before it crashes down. Well, that sounds easy. But when you are on a run and everything is looking good, it's really difficult to get out of the market, especially when everyone around you just keeps chugging along. In the online course on how to invest in crowdfund real estate deals that I'll be launching in the next 2-3 weeks, I get into detail on not only how cycles function, but also how to detect an impending correction. To find out more about, please go to the show notes for today's episode at the nationalrealestateforum.org website, nreforum.org/max, and I will send you a summary of what and where crowdfund real estate comes from and how it can benefit you. That's nreforum.org/max. My guest today is Max Sharkansky, managing partner at Trion Properties. I met Max over 10 years ago, right at the very depths of the last market downturn. They were very turbulent times, and Max had the foresight and courage to get out of the market before the crash. Since then, he's done as every successful entrepreneur has to do. He's adapted as the market has ebbed and flowed, and his early adoption of crowdfund real estate has put him ahead of the field and helped him build his company to considerable scale. Be sure to check out the show notes to today's episode by going to the nationalrealestateforum.org website, nreforum.org/Max, for links to Max's company, as well as to more information about Max himself.
We're in the business of value-add multifamily. We started out in 05-06. Prior to that, I was a broker at Marcus & Millichap. My partner, Mitch Pascover, was working on the debt side at HFF in mortgage banking. We started buying towards the end of 05 while I was a broker at Marcus. I was brokering multifamily in the San Fernando Valley at that time, so naturally we started buying multifamily in the San Fernando Valley. That's where I had access to off-market deals, market knowledge, and then from there it just snowballed. We bought those two in 05, bought a few more in 2006, and then at the end of 06, we left and we opened up our own shop. We continued to buy. We bought through the last cycle in 05, 06, 07. We sold most of our portfolio in 08 prior to the crash. We saw what was happening with Mitch being in the capital markets, myself being in the transactional markets, our properties in prior to the crash. We saw what was happening with Mitch being in the capital markets, myself being in the transactional markets. Our properties in portfolio started to tick up in vacancy, tick down in rents. We saw what was happening, and we sold in 08. As we were selling in 2008, we changed our acquisition strategy from value-add multifamily, because you can no longer make that model work, to targeting non-performing debt secured by multifamily. At that time, in 08, there was a logjam in the market, and you really couldn't make anything work. Lenders wanted to sell non-performing debt at 90 cents on the dollar, irrespective of the value of the underlying real estate. And, we were looking at it based on the value of the underlying real estate. So we bought our first few notes in 2009, which is actually how you and I met.
It is, isn't it? Did you buy anything for me, or was I selling too high?
You were selling too high. You were doing too good a job. I bought, and from there it snowballed, and we did about 20 deals during the downturn in 9, 10, 11, 12, about 15 of which were note deals and 5 just REOs. And we had a fully built out management infrastructure. So where a lot of our competitors were buy the note, foreclose, sell, because we were operators, we were buy the note, foreclose, renovate, lease up, and then sell. And that was that model and that infrastructure allowed us to buy some REO product as well. And then coming out of the downturn in 2012, we just went back to the value add business. And we currently have approximately 18 properties in portfolio, 17 with the 18th in escrow. Our aggregate portfolio value is around $240 million. We have a gross track record of over $300 million and over 40 deals.
Okay, so let's talk about how you've been financing your growth.
Track record of over $300 million and over 40 deals.
Okay, so let's talk about how you've been financing your growth, going back to 2005, 2006, through the downturn and before the Jobs Act became relevant. How were you financing in the good old days, and how has that changed?
It was the wild, wild west, especially during the downturn. We grew very organically. We bought our first few properties with our own capital. We were both pretty strong producers at our firms at the time, so we saved a couple bucks and bought our first few properties. Then we started to syndicate out to friends and family and colleagues, Mitch to some of his HFF folks, me to some of my Marcus folks, and it grew very organically. During the downturn, it became extraordinarily difficult to raise money, so we bought a lot of stuff with just high-octane debt and our own capital. And then as we got a little bit further along
And how were you raising it then? That was still from friends and family, was it?
It was all friends and family, referral-based. We met some family offices that were able to write larger checks and a lot of high-octane debt. So, we would buy notes with other debt. We would put debt on debt.
Right.
And that was very helpful in allowing us to close.
All right, so what brought you to crowdfunding? How did you even hear about it?
About it just like everybody else, through the news, with the Jobs Act passing and everything that was supposed to come of that. And then when it rolled out in real estate, you couldn't help but see it because it was in Globe Street, every other major news publication. It was in your face. If you're in the industry, it was in your face. So we started calling around. We did some deals with RealCrowd, Realty Mogul, Realty Shares, and they've all been great. They've all been great to work with, and they've all been very successful. And it has been a very large boon to our business. It's definitely allowed us to access capital that we wouldn't otherwise have had access to, and it has allowed us to supplement equity capitalizations when we very much needed the capital.
So describe the process a little bit of what it takes to raise money for a crowdfunded deal that's different from the friends and family route.
Well, first of all, there are two
crowdfunded deal that's different from the friends and family route.
Well, first of all, there are two models, right? There's, let's call it the LLC model, which would be like Realty Mogul and Realty Shares, where you interface with them directly. It's more like almost like dealing with an opportunity fund. You'd interface with one originator, call it a deal guy, and they vet the deal. They vet you as a sponsor. They do a walkthrough. They do their own underwriting. There's a lot of Q&A back and forth, not dissimilar from an opportunity fund. And you never interface with their investors, and that all happens behind their own curtains. I don't know who they are. I don't interface with them before the acquisition. I don't interface with them after the acquisition when we're operating. It's all done with the companies. Then the other model is more of the technological platform model, if you will, which is like RealCrowd and CrowdStreet. And in that model, you're effectively paying, and they still do vet you, and you go through the process. And you post a deal on the site, and you pay them a flat fee, not a percentage of how much they raise, and you interface with the investors directly. So they're contacting you based on the posting, based on the materials, having a lot of dialogue, Q&A. I've met people on site at properties. I have people that I met. We did our first property raise through Real Crowd in 2013, I think it was, and we have investors who have been with us since then in multiple deals. So either model works very well.
So going back to the LLC model, what you described as the LLC model, almost like a fund, they really are your primary contacts, and it's almost as though they are the ones investing in you from what you've described. Do they take any kind of control, or do they leverage control over your management operations and the operating agreement in any different way than the strictly marketplace websites?
Yes, they do. And that also depends on what portion of the equity they're taking. So, if if we've got to deal with a huge check, 10 million plus, and they're taking $1.5 million, they're really not going to have much input into the operating agreement. If we're raising $4 million and they're taking 2.1, then they're absolutely going to have some input on the operating agreement. Again, not dissimilar to an opportunity fund or any JV type partner that would go in and mark up the operating agreement. We go back and forth and we come to a final.
Okay, and do you have a preference, one formula over another? And if so, why?
No, we don't have a preference. There's a time and place for both, and we have used both very successfully. With regards to other sponsors, it really just depends on your business as a sponsor and how you want to grow it. And what you want depends on your business as a sponsor and how you want to grow it and what you want at that time. If you have a deal and you're stretched thin, you don't want the brain damage of talking to a lot of people, or I shouldn't even call it brain damage, you just don't have the time, you don't have the bandwidth, then go and do the LLC model. So you interface with one person and they raise the money for you, you pay them for it, and you're done. If you have a business where you're very much trying to grow out your Rolodex of high net worth investors, and you have made the conclusion that is the way you want to grow your business for years to come, then try the marketplace model. You will get investors and you keep them, they become your investors.
Now, the LLC model, what kind of marketing do you have to do? Do you do any marketing at all with that, or is that strictly the marketplace model? Or do you do any marketing at all when you do these things, when you issue these offerings?
Webinar to discuss the investment and give the investors an opportunity to dial in and listen to the dialogue and the Q&A about the investment, and then they can submit their questions at the end of the webinar, which is an effective marketing tool. But beyond that, us as the sponsors, we're not doing much of the marketing.
Okay, so you're relying on the platforms to do the marketing for you?
Correct.
And do any of the platforms guarantee the raise? In other words,
No.
They back it up with their own funds and guarantee you're going to do it, and then they try and backfill?
I think it's now evolved into that. I can't speak to much detail on that because we've never done that with any of the platforms where they've guaranteed us a certain amount, but I think that is now out there. I think Fundrise, who is, they're in that like preferred equity mezz space, they do guarantee a certain amount, but that's a little bit of a different business.
And what are the terms like, Max?
But that's a little bit of a different business.
And what are the terms like, Max, in comparison to the old days, or working with a private equity fund, for example? What are the terms like?
Well, I think what's great for investors is with the internet and crowdfunding and all these different platforms, there's a lot more transparency. So some of the more egregious terms that you would see in the old days aren't really out there as much anymore. Like we pretty much have a cookie cutter approach on pref and promote for the most part. We take 70-30 after an 8 pref, and that's worked. Some sponsors charge a little bit more.
And no waterfall?
No, not that there's anything wrong with that. Some will do a waterfall, but we keep it simple.
Okay.
No waterfall. We don't charge an asset management fee because we self-manage. So that's enough fee income for us to get by and pay the bills. Some people will outsource their management, so they do take the case. And again, there's no necessarily right or wrong way. There's a very broad spectrum of how to operate.
So I'm interested in this idea that you've articulated, that it's more transparent than it used to be and that egregious terms have gone away because of that. Can you talk to that a little bit more, please?
Sure. I think, back in the olden days, you would see much lower preferred returns much higher promotes. Back when I started in the old cycle, wouldn't be uncommon to see 50-50 after a 6. And I think in this day and age, that's a thing of the past. It's a relic because people have transparency and they have a window into what other sponsors are charging and what is quote unquote market. So I don't think, in this day and age, unless it's like a fix and flip of some sort and very, very small, I don't think you're really going to see 50-50 after a 6.
And what about operating terms and management controls? Have those...
At the end of the day, if you're doing a syndication, then you have to have controls. You might see a little bit, with some of the crowdfunding groups in the LLC model, if they have a substantial portion of the equity, if they've got 60% or more, 70% or more, they might have some controls, as they should, because they own so much of the asset.
Typically, how much skin do you put into these deals?
We're putting in 5 to 10%.
Okay, so that's fairly standard.
Yep.
Formula, right?
Sure.
All right, do you want to talk about Fremont a little bit?
Sure, absolutely.
Tell me about the Americana,
So we actually just closed on and are backfilling via Realty Mogul 88 units in Fremont, California, which is in the East Bay in the Bay Area. Many people have heard of Fremont because it is the home of Tesla auto manufacturing. Tesla is one of the hottest cars out there, and it's a rapidly growing car company. And because of that, there has been an extraordinary amount of growth in Fremont, not just because of Tesla, but also because of AMD, some of the other local employers. If you look at it on a map, it's the gateway to Silicon Valley. It's essentially the first exit on the freeway before you get to Silicon Valley in the East Bay. So very strategically located. It's got a lot of overflow from Silicon Valley and the peninsula. So we love the market and we love everything about the real estate. With regards to the asset itself, it presents an incredible value add opportunity. This is very typical of what we buy, legacy ownership. We bought it from the family that bought it from the original developer in 1966. So the basis is nothing. The debt is nothing. They've been operating it for occupancy, essentially, for many, many years, decades, and there hasn't been much capital put back into the asset. So this falls right into what we do, and that is buying legacy assets that are tired. We'll $25,000 a unit on interiors, fully upgrading the interiors. We're tearing everything out. We're putting in brand new kitchen cabinetry, high gloss, very European looking, quartz countertops, stainless steel appliances, faux wood, vinyl plank flooring, washer dryer in every unit, which is a huge selling point. People love that. All new fixtures, all new finishes in the bathrooms, tubs, vanities, just a brand new unit. And we can deliver those units to the marketplace 25% below what a renter would be paying for a brand new Class A property. So very strategic place in the market for those assets. What else can I tell you? We are stabilizing it at a low 6% cap rate on cost. Our thesis is that we'll be able to exit that 5 years from now at a high 4 cap, which is where properties there are trading now, about 4.75, 4.5 is that we'll be able to exit that 5 years from now at a high 4 cap, which is where properties there are trading now, about 4.75, 4.5, 4.75. We will grow the rents, very organically at that point after we stabilize it, 2.5 to 3% annually. We underwrote it to a 5-year hold at roughly 19 IRR, 20 IRR, I think it's like 19.5, and investor level, it's mid-teens IRR, like 17 IRR. So very strong piece of real estate, very strong risk-adjusted return.
So what are the key numbers, Max? How much are you paying? How much is it going to cost you? How much are you raising? What kind of terms are you giving to the investor?
We paid $26.5 million for 88 units. That's $300,000 a unit and $300 a foot, because they're primarily, the average unit size is right around 1,000 square feet. The price per pound is one of the lowest that has a couple of years. $300 a foot, I believe, actually is the lowest. So we're excited about that. With regards to structure with our investors, it's exactly what I discussed earlier. 70-30 after an 8. We do not take an asset management fee. We self-manage. So we take a property management fee, and we have our own crew. So we take a construction management fee also. We're raising $10.5 million. Most of it is subscribed. We're backfilling about another $1.5 million or so. So we had a very successful raise. We started a little bit late while we were in the contract period, and that's why we just have a little bit extra to raise, which my partner and I closed with our own capital, and we're now backfilling.
Don't forget to pick up your free PDF summary to crowdfund real estate and how you can benefit from this industry at the show notes for today's episode at the National Real Estate Forum.org website, nreforum.org/max.
Okay, so what are the pros and cons for somebody thinking of either floating a deal like this on a crowdfund platform or investing in a deal like this?
Pros and cons. Well, the pros, I think, are just everything that I just went through, with just phenomenal opportunity for job growth in the area, rent growth, appreciation of asset value, ultimately is what it's all about, and operating cash flow.
What's your lowest investment?
Oh, well, I don't know. So I'm sorry, I shouldn't say that. It was $50,000 direct when we were doing a direct raise, but I'm not sure what it will be on Realty Mogul because they take smaller chunks usually.
Direct raise is when you were doing it yourself, is it?
Correct.
Okay, so you did a direct raise and then you went to Realty Mogul to backfill what you were short. Is that right?
Correct. That's correct.
Okay, and has that been...
No, we've done a couple that way. It really just depends how things shake out with the raise. This was a very large raise for us. $10.5 million is a pretty large raise to syndicate out with, $50,000 to $200,000 checks. We did have a few larger investors that took up some allocation, but we weren't quite able to get there by closing. So my partner and I put in the shortfall, and now we're backfilling it.
Oh, I see. And then do you find that the crowdfund websites are more efficient in terms of the process? I mean, why didn't you go for the full raise on Realty Mogul?
Oh, I don't think that most of that. There aren't really any crowdfunding groups out there yet that can raise $10 million plus. Otherwise, I would have been happy to do it.
I see. And is the process faster? How long did it take you to raise the 8.5, and then how long to backfill the 1.5?
It took us about 45 days or so to raise the 8.5, or actually 9. It was 9. Take a few weeks for them to execute. They're very efficient.
Are they more efficient than you are, do you find?
It's a different business, right? Like they're in the business of raising capital. So I would say, yes, absolutely, they're more efficient than we are, as they should be. That's their main line of business.
And how many investors do you have on both the, again, just in general terms, Max, on a raise like this, where you've got $9 million that you've raised, and they are out there raising $1.5 million?
Well, I don't know how many will be in their entity, but we have roughly 20 to 25 investors.
Okay, and in past experience, do you find that working with a crowdfund site, there are more investors?
You never know. I don't know what they're gonna, how many investors they'll have in their entity. But with the marketplace crowdfunding platforms, we usually get, call it like 7 to 15 for a given deal, 7 to 10 maybe.
And then you meet them as in who they are after the close.
Oh yeah, no. I usually meet them before the close. And it can be something as simple as a few emails. Or sometimes I've had them come to my office. There have been times where I've met them on site at the property if it's in LA, or if the property is, let's say, in the Bay Area and they happen to live in the Bay Area. It runs the gamut.
And what kind of, look, you went through a downturn and you did well out of the downturn. How are you insulating your portfolio now against what inevitably will be the next downturn?
Don't say that. Be more optimistic. I'm just kidding.
Of course, it's just going to keep on going up. Exactly.
Yes, I wish. I think that one of the things that we do that really helps us hedge risk is low debt. We're not putting an extraordinary amount of debt on our properties. Fremont, as an example, we're levered to about 68, 69% of cost.
Okay.
And then, so we'll take 68, 69% at closing, and then the lender will fund the rest as we're improving the asset. And then once we refi out of it, we'll be right around the same leverage at 65 to 70%, maybe even a little bit less than 70, probably more like 65 to 67, 68% of the new value based on the increased NOI.
Now, is that a decision that you make, the level of leverage, or is that bank-driven, or is that platform-driven?
That's a decision that we make internally. We try not to squeeze every last dollar out of it, because if there's a hiccup, that's how you get hurt.
Exactly right.
Real estate won't kill people. Debt will kill people.
Exactly right. That's what
right.
we saw during the downturn.
Absolutely.
Excessive leverage.
That's right.
Do you recommend crowdfunding to other developers?
I would recommend it. I think you'd be crazy not to do it, whether you're a young sponsor or an old sponsor.
Funding to other developers?
I would recommend it. I think you'd be crazy not to do it, whether you're a young sponsor or an old sponsor. I've seen, groups who have been around for a few years doing it. I've seen groups who have been around 25 plus years doing it. It is a phenomenal supplement to your investor base, and you're crazy not to do it. It's a win-win-win for all involved.
Have you invested in any deals that are not yours on other websites?
No, I have not. We're pretty young guys, but I would not.
All right, good. So, do you have anything in the pipeline at the moment, or on the horizon?
No, we have something in contract right now, but it's already fully capitalized.
Nice. Okay. And how have you capitalized that one?
So we have a fund as well that we launched last year, and that fund has 8 figures in it. We're raising a couple million more. And so we've got, it's a small equity check. I mean, it's, $5-6 million bucks. It's around $5 million bucks. So we're raising we're going to put in 2.5 out of our fund. And then we have one high net worth investor who took the rest.
And is that blind pool?
Well, it was blind pool going in. At this point, anybody who invests will be able to see 5 of the assets in the fund. And we're only buying 1 or 2 more at this point because we're nearing the end life of the fund, or the end period of the investment period. So it's at this point, if you're investing, you're investing more so into a portfolio than a blind pool.
And is that something that you can do on a crowdfunded website, or is that something you do separately?
Correct. We do. I should say the former. Yes, we do it on a crowdfunded website. We've done it we have it on Real Crowd. We have it on CrowdStreet. Realty Mogul is actually going to launch it in a couple weeks. So yes.
So it's a fund, is it, with an investment thesis rather than individual deals? Is that how you do that on a crowdfund platform?
That's correct. Well, we're very niche investors, right? We are not jack of all trades, master of none. We don't buy 5 different asset classes all over the country. We're buying value-add multifamily, 60s and 80s vintage primarily, 60s through 80s vintage in 4 markets. We're in San Diego, LA, Bay Area, and Portland. Fremont, as an example, went into the fund. We wrote a $2.5 million check out of the $1 million check coming out of the fund and going into that, and then our investor will be taking the balance of the allocation.
I see. So the fund is a single investor in some of these deals, a partial investor in some of these deals. Correct.
It's almost like a GP fund.
Interesting. And the same kind of terms?
On the fund, it's 75-25.
Okay.
And after an 8% pref with a catch-up.
And how does that balance when you invest that into a deal that's like Fremont that has different economics?
We rebate the fund. We do not double promote our fund or any of our investors. We find that to be, it's just not something that we do. Mm-hmm. So any promote that's taken on the property level or any fees that aren't in the fund docs, say for example, a construction management fee, which we have in Fremont, but we don't have in the fund docs, will rebate towards the fund. We don't have in the fund docs, will rebate towards the fund.
I see. That's an interesting structure. Is that, it's not a simple structure. I presume that you find some of your investors are relatively new to real estate. Would that be accurate?
Yes, it would. But the rebating is, it's actually not that complicated. So if, let's say, for example, our fund has $2.5 million of a $10 million equity check, that's 25% of the equity. So when the deal realizes and we go to get a promote, we'll not charge the fund 25% of the promote. So fairly straightforward.
Do you find you have to explain real estate concepts to your investors very much, or are they just primarily looking at returns? What's their key driver, do you think?
Well, I really don't have to explain real estate concepts. It's a fairly straightforward business. It's the business of. Well, I really don't have to explain real estate concepts. It's a fairly straightforward business. It's the business of apartments. So, we take an older apartment, we fix it up, we make it like a newer apartment. We go into the details of all that, as I did earlier on the call, and they understand. It's not rocket science.
It isn't rocket science, but when you're a rocket scientist, it seems easy, right?
Yeah, that's right. Well, we try to keep it as layman as possible.
As a real estate guy, what are the key daily habits that you have to make your business successful?
I think one of the big ones over the years has been less focus on every little intricacy of the deal itself and working on a deal and on every micro detail of an acquisition, and growing into more of it and building out a strong acquisitions team and building out a phenomenal operations team and a project management team and an accounting team. And like any other industry, any other business, it's all about your team. This business is not about me and my partner anymore. We've grown way past that. It's all about our team. So that is the most important thing in our business.
Okay, my second question. What has been the hardest lesson you have learned in real estate?
The hardest lesson, capitalization. And that comes back to what we were just discussing. Real estate doesn't kill people, debt kills people. Fortunately, it's not something that I've had to learn much firsthand. We've never lost a property to foreclosure. We've never had any issues with any of our lenders. But, we saw the carnage. We were, as I said, we were on the other side of that carnage. So we understand how a perfectly great deal, a perfectly great piece of real estate and great opportunity can be destroyed with poor capitalization.
Okay, and then number 3, if you could give one piece of advice to somebody who has not yet invested in real estate but is thinking about it, what would it be?
As a limited investor?
Yeah, as an investor on a crowdfund platform.
As an unsophisticated, sure. Somebody who's a first-time investor on a crowdfunding platform, I would suggest that you thoroughly vet the sponsor's track record and you thoroughly vet what types of fees they're charging on the deal to ensure that you, as an investor, have an alignment of interest with your sponsor. So if you see that your sponsor is charging extraordinarily higher fees, and when I say fees, I mean just that fees, acquisition fees, placement fees, exit fees. If you see that the fees are significantly higher than the other sponsors in the crowdfunding world that you're seeing, then you might want to think twice about doing that deal. If they have a extraordinarily higher promote than somebody else, you might want to think twice about that. But more so with the fees, because there should be an alignment of interest. Like our ethos is, if our investors make money, we make money. Otherwise, what's the point?
My favourite line from Max today is his comment that it is not real estate that kills people, it's debt that kills people. Never has a word been more spoken in truth. When I was working through billions of dollars of deals during the last downturn, the term that was most misused was that it was distressed real estate. It wasn't distressed real estate. The real estate was just fine. It was the layers of debt on the real estate that was in distress. The same idea is echoed by Glenn Muller, one of my guests from Series 1 of the podcast. When asked what are the most important in real estate, Professor Muller unhesitatingly steers clear of the novice's cliched location, location, location response, and instead states that quality buildings with good tenants and low leverage is the key to success in real estate. I could not agree more. The next podcast will be with Sarah Hanks, co-founder and CEO of CrowdCheck. CrowdCheck provides due diligence, disclosure and compliance services for online capital formation. She helps investors get the information they need to mitigate risk of fraud and to make informed investment decisions, and she helps entrepreneurs and intermediaries avoid liability. Sarah is another guest with a fabulous accent, so be sure to tune in, if even only just for that. You can subscribe to the series on whatever platform you listen to podcasts, at the nationalrealestateforum.org website, nreforum.org, and hitting any of the links that I've included about halfway down the homepage. Thanks for tuning in and thank you also to Max Sharkansky, Managing Partner at Trion Properties, for sharing your... Until next time, this is Dr. Adam Gower, signing off.